Hi there, everybody. Thank you for being here with us today. Super excited about this panel, Real-World Assets on-Chain, the future of them. My name is Lauren Halstead from Chainlink Labs. I am the Influencer Marketing Manager. Here today, we have a great panel. Super excited. So just to start things off, let's just level set right now. If you were to explain to your grandmother what a real-world asset is, how would you describe it? Love to keep this super conversational, so whoever wants to jump in and talk, please feel free. And in which
you
case,
already put the challenge too high.
I took the challenge too high. All right, Edwin, take us off.
I mean, real-world assets is just an asset, right? So we're calling it real world just to differentiate it from a digital, but I mean, the whole world is being structured around the real-world asset. So it can be like a building, a mineral, art, whatever, right? So it's kind of like the process of how we digitize that, and nowadays how we put it on chain. So that's kind of like the path we're trying to all accomplish here. And it's kind of like that real world asset that exists in a natural world, natural state. How can we digitize it to bring it on chain and provide all the characteristics that blockchain itself bring? So that's kind of like how would I explain. To my grandmother, I would say your house.
Perfect. And then say you're walking around the mall and you run into somebody and they say, so why should we bring real-world assets on-chain, and what are the benefits? How would you respond to that, Andrew?
I wouldn't talk to my grandma about this. Yeah, I think it's, in the asset space, and it's related to a previous talk actually, is, basically access to faster and cheaper capital is key. That's kind of how you deliver most alpha. And so theoretically, we're not there yet, but theoretically, Web3 effectively gives you global access to capital that is, you can access instantly. So global means that there's a lot of it. Fundamentally, the price should go down, and instant means that you can, tap into it instantly. And so theoretically, this should be the best way to capitalize, anything that's real in this world. And it should be superior to the rails we have today. That's the theory, at least.
Yeah, and to build upon that point a little bit, there's really two different sides of the benefits of real-world assets now that it will eventually converge. You have the DeFi side, what are the benefits to bringing real-world yield on-chain, and that is that you have treasuries, that people like Nick here are bringing on-chain. They offer 5% yield and are fully composable with many of the DeFi protocols everyone knows and loves. After all of the token farming, yield farming died down with the de-lever of last year. And there's also the traditional finance side, which is much more Andrew's point of how these systems can be much cheaper, more effective, more efficient for TradFi. And eventually these two worlds will collide, but it's just a matter of how we get there is the major question.
Definitely. What do you think are like the top 3 real-world assets that make the most sense on chain?
For me, it's stablecoin, because especially in the Philippines, where like what I've said before to my co-speakers, almost 50% of the population in the Philippines are still bankless. And right now, with our company GMX providing remittance solutions to foreign nationals, making USDT as making them convenient and effective for them to remit money abroad, say for example in Vietnam, Thailand. And it is cost-effective, faster, and it's easy. It's less scrutiny also, especially for our Chinese clients.
I would just add that I think I agree on the stablecoin side. I think it's probably one of the biggest sources of demand today, right? And ultimately, what assets are going to be brought on chain? It's assets that have demand on chain locally for them. So currently, it's been treasuries. Most of the existing DeFi protocols are built for liquid assets like stablecoins and other liquid digital assets. So naturally, treasuries become a compelling collateral to add. But that's going to expand, right? So as these protocols start improving their underlying infrastructure, they'll be able to onboard different types of assets for different reasons. I think decentralized stablecoins are going to be one of these that start progressing quite dramatically over the next 12 months and start taking a lot more different types of RWA assets as collateral.
Which I guess I would add, because stablecoins really won the last cycle. That should tell you what, what are some attributes of the next successful asset. And I think stablecoins won because people understand them. Around the world, everyone understood the first use case, honestly, I'd say at scale, that's really captured the imagination of normal people. So what is the next asset? I mean, it's things like that, we're focused on real estate, but it's like things that people can relate to, things that you talk to your grandma about.
Great.
grandma or grandfather or either or. Yeah, so I actually came from a background of distressed investments, and real-world assets was the first thing that everybody in the hedge fund world was super excited about, putting real estate on chain. I remember hearing about, creating markets to be able to bet on the futures of the Upper East Side versus Soho, and that kind of sparked my imagination and got me more interested in crypto. But so there's just been so much talk about it over these years, and what's really preventing this from becoming reality?
Well, from a technology standpoint, it's getting simpler. So yes, in 2017, the first security token offerings were started getting ignited and companies trying and testing. But on that side, the adoption rate was not there because obviously you can issue or mint a token and then you expect people to just invest, but you have to provide all the outside the technology layer, the service layer. How are you going to generate that investor pool for that tokenization to occur? So I believe like one of the biggest setbacks was, the solutions were to Web3 still. There was not like an onboarding process for people to still go for like a Google sign-in. I mean, they were still too dependent on the wallets, and not a lot of people still feel comfortable about using wallets. And now it's getting way more easier with account abstraction and some other like providers already focusing as to how we're going to onboard Web2. Releasing that barrier, I believe that the next one will be how are you going to adopt, or what kind of marketing strategies will you create to be able to provide a service or an investment where investors feel confident that what they're investing is true. So there's like Chainlink doing proof of reserves, and then all that auditor of trust. So it's all about generating barrier-less interaction with the asset that is tokenized, and also where is the trust value being generated from.
Yeah, I really want to build upon that point of, in one word, just trust. And we can go back to looking at why Circle and USDC and Tether, these are all extremely trusted assets, and that's why they're able to be used in the crypto ecosystem so readily. People trust that the Ethereum on the Ethereum blockchain is actually Ethereum. People trust that USDC actually has dollars backing it. And a lot of people who use Tether, they also trust that it has real backing. And we need to bring that to more sophisticated assets in order for those to take off as well.
Yeah, and I'd like to add on what Edwin mentioned, that because the approach is mostly Web3, because I just attended the Philippine Blockchain Week, and it has been a key topic. How do we bring more people from Web2 in Web3? So me, personally speaking, I'm still young in this technology, and when I first dive in, it's like a different dimension here. The words that you use are quite different. It's very it's not user-friendly, I must say. So I think we should be able to keep up, simplify some of the processes in terms of onboarding them, especially in the Philippines where the markets are very conventional and traditional. So if the process seems very tedious and it's very hard to understand, you won't be able to onboard such as institutions that are already established within the country. Say, for example, like the government or the merchandising companies or the big companies in the Philippines. It has to be very simple for them to understand so that it will be easier for them to grasp the process of what is really Web3 and what we are currently building here.
Yeah, I would just add, I think also the elephant in the room is just capital. I don't think we talk enough about just how little liquidity exists in all of DeFi. I think at its height of the last cycle, I think the DeFi reached 200 billion, if I'm not mistaken. I think it's down to about 40 billion right now, which is, that's like one real estate private equity medium-sized firm in the US, right? So the equivalent of one fund is all of DeFi globally. And until that changes, it's just not a serious source of capital, unfortunately.
Yeah, I'll just tag on to that. I think liquidity is a super important function. I think to answer your question, Lauren, we have seen quite a bit of adoption already this year. We're, Charlie, 1.7 billion of tokenized RWA assets? You guys track this stuff, right?
Yeah, somewhere around there.
This is came from zero, basically. And that's not including USDC. I think people don't understand how much adoption has already played out. But there is a significant sort of expansion effort that's currently underway. All the existing technology is in place to basically create these liquidity distributions throughout DeFi, through every L1, every L2, every roll-up into different dApps directly. And that's one of the things we're working on. But basically that liquidity distribution on chain is sort of a fundamental factor. And in fact, that's kind of why the initial push for RWAs in 2017 failed, right? We didn't really have stablecoins. We didn't really have DeFi. We have the infrastructure now. We have the underlying Chainlink to provide proof of reserve and CCIP now to enable more distribution on different layer 1s and layer 2s. So everything is there, right? Builders are building, and this expansion is happening.
Yeah, does anybody else have anything to mention about how to lead to more liquidity in general?
Yeah, I think it's actually a pretty simple equation when we talk to institutional investors, traditional folks. They really just care about making money. Will a tokenized version of an asset have a better risk reward than the regular version of that asset? Now, there's a few ways that can happen. If the asset is only available in crypto, then they're going to want to seek it out if it's a good asset. But if you have the option of doing both, doing either, it's just a fact that there is more risk in the tokenized version of an asset right now. And one of the ways to reduce the risk, to the point before, is of increasing that trust to where they can actually guarantee that they get their money back if something bad happens. But we also need to get to the point where the cost savings that Andrew mentioned at the very start are being realized through economies of scale, network effects, and reduction of things like liquidity risk.
I definitely agree that we need the institutional money to start jumping on in RWA. Luckily, I think one of the biggest advances right now is at the regulation level. There's been some upgrades that kind of like the compliance of these institutional players start feeling confident, because now they have a clear path as to how the securitization, digitization, tokenization phase can occur, so they're playing by the rule of law. It was always available and possible, but me myself as a lawyer, I understand that the perspective of in a regulation being allowed directly tokenization, that is how it's happening in Europe. There's various players from banks, from family offices trying to understand if this is going to be a new asset class that they can invest and they can generate yield, because obviously for them, if the DeFi starts getting moved, and it starts going again back to the previous years. I mean, there's a lot of yielding, so you don't go back to the bank for interest. You can go and play on your own terms. So there's a lot of possibilities. So I think the interest is there, but we do definitely need institutions to keep jumping in and trusting that what we're building is as solid as the infrastructure that they used to use.
One thing I'll just add there is I think one thing that's very under-discussed in the concept of RWA is, right, if you're an institution, you're a family office, or you're a fund and you want to allocate into DeFi, that is very daunting, right? You're deploying USDC that can be rugged, can be hacked, can be moved, can be removed from you. I think one of the things that RWA is going to enable is just a huge proliferation of experimentation of these different dApps, right? Because even in the scenario of a hack or a smart contract related issue, in the best implementations, at least on the RWA side, these assets have some form of transfer restrictions. Not in all cases, but in most cases nowadays. And what that really does, it prevents a hacker from moving the asset to another wallet, and it does provide an additional layer of trust to do this experimentation, earn extra yield on these safer underlying assets without worrying about getting rugged on the latest protocol.
Perfect. Do you think that DeFi can aggregate enough to attract these institutions? Are they going to be coming to us, or are the institutions going to have to invest first for this to become, an actual reality?
I think this is a trillion-dollar question, because actually in TradFi you have the same problem where you have all the, at the forefront of interesting investments are usually people who tend to be wealthier. Wealthy people tend to have a lot of opportunities, a lot of access. They don't really experience any of the friction because they have people kind of doing that for them. And so you have this situation where there's a lot of adverse selection that I think is now seeping into DeFi effectively, because all the wealthy investors and the funds with a lot of money are perfectly happy staying exactly where they are. And so to convince that group of people, again, the best investors and the best sort of funds to move over to these rails is a really daunting prospect. I tend to, sadly in some ways, but I think it might be too big of a problem to solve with just individual investors. Even at global scale, we probably need to have a couple of big institutions really jump in and kickstart some things.
And to be clear, the institutions are definitely looking at the space extremely, extremely closely. You have JP Morgan with Onyx. They spun out from an organization in Consensus that was doing enterprise Ethereum, and they're processing $900 billion of repurchase agreements, lending against treasuries intraday. And that's simply because they know that they can enable new things with that lending for their clients that they couldn't do otherwise. Normally they have one-day settlements, T+1 settlements, so you can't actually lend against a treasury for less than a day. But they have a lot of clients who, they're day traders. They don't hold anything overnight, so they want that liquidity. And that's an example of how banks are experimenting with all this stuff. They're just not allowed to bring it into the public blockchains for some regulatory reasons, and just because to Nick's point, they don't want to get rugged. They don't want to get hacked. They don't want to be exposed to those sorts of risks. So for now, until all those problems are solved, the institutions are just stuck in their own walled gardens, and it's not exposed to the rest of the ecosystem.
Yeah, I'll tag a little bit onto that. I've been making this comparison. So if you, obviously for folks that have been around the crypto space, everyone was always asking, when are institutions going to trade Bitcoin and ETH, and when is that going to end up scaling? You could have made a very similar case around, the fact that they're not going to start doing this until Bitcoin's listed on NASDAQ or, some traditional exchange. And what happened, right? Like they went to Coinbase, they went to FTX, they went to Binance, and they went to where the markets were made, they went to where the opportunity was, and they deployed, right? As sort of they FOMO'd in whatever way they needed to eventually in coming in. And so I think it's a similar aspect here in RWA. There's different infrastructures. These infrastructures will allow these institutions to onboard, whether with their own assets or with other people's assets, offer their clients different use cases. They're going to onboard with the existing infrastructure that's being built over the next couple of years that is serving treasuries, DAOs, protocols, whales on chain, right? And as the institutions start feeling more comfortable, they'll basically slide right into the exact same infrastructure, is my opinion at least.
Yeah, definitely some great points there. Does anybody else have anything to add? Maria?
For me, I feel like it's a two-way street. So I think with institutions, say for example, Axie Infinity in the Philippines, crypto and blockchain has not become, has an exposure in the Philippines until the pandemic came, because Axie Infinity has become the gateway for most Filipinos to understand what is blockchain, crypto. That's why we started doing already different events such as Philippine Blockchain Week. And for me, it has not only captured the market in terms of only regular Filipinos, but as well as the Philippine government and some of the institutions. That's why some of the big players in the Philippines, such as Smart, Globe, and GCash, are already partnering with different exchanges in order to incorporate crypto into their businesses. Yeah, so it's like a two-way street.
Anybody else? Anything else to add there, or we're good? So I guess we have about, kind of ending towards the end of the panel, but what are we thinking for the future? 3 years, 5 years, 10 years, 15 years, 100 years, 1,000 years? What do you see happening? we can spectrum out. That was 1,000 years is a little far, but I have some predictions. But love to go around, starting, you want to start with Nick, and share what you see happening?
Yeah, I mean, over the last 6 to 12 months, we've probably seen a dozen of these institutions, banks specifically, coming out with research reports around sort of the next 10 years of RWA, broadly expecting around like 10 to 16 trillion of tokenized assets in the next 10 years. We did a similar approach. I think we have a little bit of a different perspective than the institutions are currently looking at it. They're mostly looking at it from the cost savings perspective. I think there's a much significantly larger TVL opportunity when you take into account the liquidity and the cost efficiencies that can be captured on chain as well. So I do think it's going to be a much bigger market than they're currently expecting. I think we put out a similar report that in the next 10 years we think it'll be double, so about 30 trillion. And realistically, that may surprise all of us as well. Just look at the growth of Circle and Tether and just reapply that to RWA.
Am I next? Sorry. Okay. So in my opinion, regulatory regulations within the government, if they would be helping Like if they would secure rules that is already crypto friendly, then it will fast track the whole this whole effort. But if not, then it might delay the timeline. But of course, given the public scrutiny and technology upgrades, of course, it might still take a while. But for me, if the government, we will have their support, because in the Philippines, they are supporting the technology, but they are not adopting it yet. So meaning the Filipinos, they are still waiting for the government's like last call. Yeah, so if they will be adapting it, then definitely most of the countries will also be like diving into the technology.
Yeah.
Edwin?
My side, I'm looking forward for the equity tokenization of things. So I think all companies could be embedded directly into the blockchain. We're already seeing some stock markets being built. Here in Europe, they got the DLT regime, where it's about creating that tokenized version of a stock market. And I believe that if you have stable coins, and then you have CBDCs, and then you have equity running on chain, it's just going to boost the adoption of everything on RWA related. So I believe that in the 5 to 10 next years, we're going to see a lot of movements around getting all these stock markets that are on their tokenized versions. And then we will see companies, even vehicles of hedge funds or VCs or SMEs or whatever, trying to understand the characteristics and benefits of having their chain, their company on chain. And then if they want to go public, they have access to that new public markets that are going to be starting to create, and hopefully with enough liquidity for everything to make sense.
In the long term, I think that all assets will eventually be tokenized. I think tokenization is the technological endgame for all asset ownership and asset settlement, just because it is so efficient and more transparent, even when you need to add on privacy preserving measures like all the great ZK work that's being worked on by probably many folks in this room. But in the short term, I really think we saw stablecoins, like Andrew said, they won the last cycle. But I think we're really just getting started in terms of the use cases for stables and what's possible in the future. We really saw all the crypto native use cases, a lot of yield farming and other fun DeFi things that happened. But now we have folks like Visa, a lot of different banks. We have almost every single central bank looking at a CBDC and looking at stable coins, comparing them, contrasting them, figuring out how that plays into their own monetary strategies at the very highest levels of government and central banking. And I think we're now going to see just exponential adoption by companies that have real money, not just financial institutions, but also just any payments companies, financial fintech startups that just want a better backend. And so we might not always be able, probably won't even know that a lot of these fintech companies, when we send a payment, are using stables behind the scenes, but we'll see it in the TVL, we'll see it on RWA XYZ, if you want to check out all the stablecoin TVL and other RWA TVL.
Yeah, I think, I mean, first of all, it seems inevitable, right? So I think it's, I don't know, to say 1,000 years, 100%, right? But, so it's inevitable. I think it's really good technology for moving money around the globe. That's kind of fundamentally what I appreciate. So the thing I appreciate about it is kind of a person who spent a lot of time in payments. I think and I kind of repeat what everyone else has said, the regulatory piece is the biggest modifier to that timeline. You know, if the U.S. government, for example, I mean, very U.S. focused, obviously, but if the U.S. government tomorrow, came out with a coherent set of, rules around how we tokenize assets, we could see massive shifts in the space of 2 to 3 years. If they continue kind of doing, what they're doing today, which is effectively just like pretend nothing's happening, it could take much longer. I think for us, I think everyone, in this room and generally in the industry, I think we need to meet them halfway to some extent, right? I mean, tends to be, unfortunately, we're ruled by folks substantially older than us and people that don't want to change. So we need to kind of help bring about some of that change. And so a lot of it, I think, has to do with, and you're seeing a lot of people being much more clear-eyed these days, less of an anarchist attitude. We're not here to burn everything down. Yep. We're just here to kind of make it better, hopefully. And I'll use just one example, maybe just to really bring that home is, again, in real estate. Like in the United States, everyone remembers in 2008 we had a big crisis which was brought on by effectively speculation in the real estate space. Very much akin to all the stuff that happened in crypto in last year. And what happened is, as a result of that, there was no one went to jail, but there was a lot of new regulation passed that was meant to kind of safeguard the consumer. A good example of that is, post 2008, if you're taking out a loan against real estate, there's a mandatory 3-day period where you have the right to basically say no to that loan. So you can't just, a bank can't come to you, give you a bottle of wine, say sign, and then you have no recourse. There's a 3-day recourse. And that goes against everything we're building, which is instant settlement, right? And so that's a system that we have to build in. This sort of, some of that friction and some of that, it exists by design. It exists to prevent people from making mistakes, prevent people from being rugged, et cetera. So that's an example of, we're really focused on this, in terms of tokenized real estate. You really can't build something that, somebody can tokenize their house and sell it in 30 seconds, even though you can, because there are some rules that you have to abide by. So building systems that sort of, I think, respect some of the regulation and is a path to probably get broader acceptance by the government, which in turn is the biggest multiplier, I think, in this space.
Yeah, definitely. I think just back in 2017, the euphoria and everybody would describe as tulip bulbs and 1,000x, 1,000 years, 1,000x doesn't sound reasonable. It doesn't sound like a real thing. So just giving confidence and making this more a reality, and also just explaining and people understanding, what we're trying to do and build the future is extremely important. I guess in the last few minutes, any other use cases you'd like to tell your grandmother or grandfather of what the future of real-world assets is on chain and how that will affect them? Any of the panelists happy to share?
Everyone's looking at me, so I'll go for it.
Yeah, go for it.
I think the really short answer is that I hope Grandma's not trading any sort of complex structured products on chain. I do think Grandma, though, may be transferring stable coins. And I think having better stable coins that Grandma may choose to hold her cash in instead of banks, that may be passing some form of yield onto her, that she can, maybe do things in the real world and spend it in some form of capacity through an application of sorts. That is realistically the connection, right? It's creating a better, more scalable, higher yielding form of stablecoins that more people can use and touch, and abstracting the complexity of RWA behind it.
Yeah, one of the most interesting trends that we see is the launch of these yielding stablecoins. Circle, when the rates went to 5%, Tether, rates went to 5%. They're making billions of dollars every single quarter on the difference between not passing on any of that yield to on-chain holders. But people still use it because of the convenience yield. You have cash in your wallet, and why do you hold that? It doesn't yield anything. It's for the convenience. But now we're going to start to see stable coins that can bridge the gap between that. You can have both the convenience of a stable coin, being able to transfer. Grandma can pay her bills, pay for groceries, but also when it's just sitting in her wallet, she's just able to earn the 5% or whatever rates end up being when that becomes the case. So I think that's a really exciting use case that is previously not really possible. You don't pay for your groceries in a portion of a treasury note.
All right. Well, if there's nothing else, I'm so excited. I'd love for everybody to give them a round of applause. Again, I do believe this is the future of blockchain, and I'm so excited to be working with Chainlink, who's building these products and tools to make this an actual reality and make crypto the future, Web3 the future. So thanks, everybody, and I hope everybody has a great rest of the conference. I'll see you all out at the floor. Have a great night.